Hello, and welcome to the Pinnacle Economic Brief for the fourth quarter of 2025. It's part of our Effective Advice series. I'm Rob Garcia, Regional Chairman for Pinnacle in Atlanta, and joining me is Mac Johnston, Pinnacle Senior Economist and Market Analyst. Welcome, Mac. It's great to be with you again.
Thanks, Rob. Glad to be here.
You'll hear me reference to Mac's report. You'll be able to find that on the pnfp.com/econ. It'll be a printed version on the website. So, Mac, third quarter was no shortage of activity. We started off with last quarter. We talked a lot about the one big beautiful bill, and we have at least a quarter to see it
Right.
to work. We had a lot of activity in the tariffs front and finished the quarter with a government shutdown. I think
right.
you have seen the gamut in the third quarter. Talk to me a little bit about. We're going to talk about tariffs in great detail, but talk to me a little bit about what you see and how do you see what's happening in Washington, particularly the shutdown impacting all of the economic metrics.
Well, from an economic standpoint, it's a negative. About 15 to 18% of GDP is government spending, so it's a net negative. Even if Trump does not terminate or let go of the employees, just the furloughs and all that occurs during a shutdown are negative. Secondly, the biggest negative I would think from my standpoint would be that they've really sort of, we have a whole calendar of economic data that comes out, weekly. They've slowed all that down and postponed most of the data for 2 weeks to a month. Some data we have no clear date as to when that data will occur, like the September unemployment report.
So economists like you have been going through withdrawals with a lack of data, right?
Right. And I understand the battle on spending between the two parties, and I understand what the Democrats are trying to do, and I understand what the Republicans are trying to do. But right now, it seems like they're very far apart.
Well, and again, we don't see the end in sight. Just the news today, everybody's kind of dug in, so that could last longer than we all anticipate. And
That's
I
correct.
guess it remains to be seen what the overall impact is going to be. Tariffs was clearly a big part of the discussion again in the quarter. Talk to a little bit about the impact of tariffs, and now that's been in place for a little while, but a lot of good things have happened. And, you hear a lot of deals that have been cut with foreign countries and foreign companies, and so maybe the tariffs are having some of the desired effect. Talk a little bit about that.
Yeah, I mean, in early April, the Trump administration brought out these sort of reciprocal tariffs. I think it was a whole shock to the system. I mean, tariff rates for a country, an area like the EU, would go from roughly 3% to 13 to 15%, depending on the item. A number of deals have been hammered out. I think the administration sort of hurt themselves by giving China such a good deal out of the chute. Negotiations still are ongoing with China. They're your second largest trading partner. But, the tariffs clearly are a net negative economically. They lower GDP growth and raise inflation rates. What we've seen on core inflation so far is about a 0.5% rise in core inflation. And if you went back to this time last year, core inflation was in the 2.4 to 2.5 area. We're somewhere between 2.9, 3%. So that makes the Fed's job much harder.
Well, so but again, there's some good parts to the tariff. I mean, look, we've collected $165 billion worth of revenue year to date. I think it's projected to be about $200 billion. I mean, that's $100 billion here, $100 billion there, starting to add up to real money. So all of that is a positive aspect of it. But do you think the inflation increase, though marginal, probably driven by tariff, but is it as high as you would have thought because of the tariff?
I think you can debate how the tariffs impact inflation. What I would say is that the pass through of those tariffs is being paid by the exporter, the importer, and consumers.
Right.
So what we're seeing is that it's clearly has raised prices. So you have this elasticity demand issue where you're selling less goods. I think overall it takes time. I think when you look at tariffs historically, if you went back into to the Great Recession in the 30s. What you have is when you introduce them, they create a lot of dislocation and sort of a downtick in economic growth. Over time, as you onshore manufacturing and you protect certain industries, there can be a benefit to it, but that benefit, if the Trump administration continues on this path, will be past when his term ends, where I think a lot of the benefit will show. Also, I think you've got to, not listen to what Trump says, but watch what he does. That,
Isn't
you
that
don't
always the
really narrow,
case?
the tariffs need to be a means to an end. Everybody, all the countries want access to the U.S. market, but a lot of them want to be protected within their own shore, within their own country. And so how all this works out over time, will really dictate what economic growth looks like.
Right. And again, you read a lot of different perspectives there. I mean, a big part of the tariff play, as I have read also, it is part of a long game, right? And it is really intended to drive and bring back manufacturing to the U.S. So much of that has left our shores over the last 10 years or so. But you're seeing that happen. I mean, in Georgia, we have such tremendous investment, foreign investment. We got plants coming up all over the place outside of Atlanta. But the impact of that, like you said, it's not going to be for several years. I mean, it'll be 5 years before that plant generates a single product.
Item. That's correct.
And so consequently, the jobs that come with that are going to be kind of delayed as well. So, but I think certain to come. But all that remains to be seen. But talking about jobs, talk a little bit about the labor market. That's been a challenging statistic for us, or a challenging trend for us.
So the labor, as the economy has slowed, the labor market has been weakening for the last year or more. We've really seen the labor market sort of slow down in the last 4 to 5 months. The unemployment rate has really moved from this year from around 3.8% up into the 4.3% area. We expect it to continue to rise into early next year to around 4.5%. So the jobs market is slowing. I think a number of items are hurting that. I think consumer confidence is being negatively impacted by tariffs and price levels. I think overall economic conditions have slowed, and the tariffs are partly to blame. And the Trump administration needs to move past tariffs and stimulating the economy. But I think as a part of that stimulation, hopefully you can create more jobs. But there's been a lot of dislocation. And then artificial intelligence, which is there's hundreds of billions of dollars being invested there, is sort of helping the U.S. economy keep muddle along, if you will. And, overall, I think that presents challenges to the labor market also. So we're just in a period of weakness, and, I think the Fed needs to become accommodative this year and stay accommodative. And if they do that, things might work out.
Well, we're going to talk about market economic winners and losers in a few seconds, but borrowing a data point from that, AI obviously has been a huge area of growth from an economic standpoint. I mean, that could conceivably exacerbate the labor challenges for us as more jobs are displaced because of it. You see that?
That's right.
Accelerating?
I mean, lower end jobs, I think for professionals, you hope that professionals and salespeople, that'll make them more productive, allow them to prepare papers and proposals and everything quicker. I think in certain manufacturing, AI will take over. I think the biggest change, is education. I think the whole educational process will change with AI. It's not going to be about memorizing stuff. It's going to be about reasoning and using AI to be able to solve complex problems.
Well, the dollar's been also a big topic of discussion. Weakening, the dollar's weakened some, and we're seeing a trend toward weakening. But on the surface, that sounds bad, but that's not always bad. Talk a little bit about that.
Right. I think that's especially surprising given the tariffs and the announcements. Typically in economics, when you look at tariffs and microeconomics and add a tariff, you take in this cash flow we've already spoken about, and that typically strengthens your currency, which is a partial offset. Mm-hmm. But, other central banks around the world were aggressively cutting rates early last year and have really paused, while our Fed's probably going to continue to cut. So I think in the short term, that's weakened the dollar. We saw the dollar really bottom in September. It's picked up a little bit, but a weaker dollar is net stimulative. It allows exporters, if you're Caterpillar and you're trying to export heavy equipment across the globe, it makes those goods more competitive. If you're a multinational company like Apple and you're manufacturing or selling a lot of your product abroad, when you redenominate, it creates sort of a tailwind on FX versus a strong dollar creates a headwind. So
But
it's
if you
been
import, it could have an inverse effect, right?
That's
I mean,
correct.
Because weakening dollar makes the
those
imports
things more expensive.
So add that to the impacts of tariffs, and
You get a double whammy.
that could be inflationary, right?
That's
I mean, that could be an impact to the inflation.
And to go back to manufacturing, I mean, manufacturing, is still has been sort of dead on arrival. Those statistics are in very poor shape, all the way going back to the pandemic.
Yeah. Interest rate is, we're in the banking business. I mean, I get the question at least 3 times a day. What do you think interest rates are going to do? Man, if I knew that, I'd be on some beautiful island somewhere. But tell us a little bit about where you see the direction of interest rates, because there's been a lot of activities. We had a cut finally.
Right.
And I think you and I were chatting before. I think you anticipate or feel pretty strongly you see more cuts coming.
That's right. The Fed cut 100 basis points in 2024. We spoke last quarter about the conflict between Trump and Powell. I think got the Fed to a more hawkish place. They paused for 9 months as economic conditions were sort of whipsawed by tariffs, and they weakened. They did cut in September, as you mentioned. Right now we've got a meeting they'll announce on October 29th, another one on December 10th. Current probabilities are 100% for the October meeting, 97%. For December, and that'll mean a total of 75 basis points this year. I think they'll cut 50 next year. I would think maybe March, June, and then maybe late next year. And then we'll end up with some kind of 3% terminal Fed funds rate,
Right.
which will equate to about a 6% prime and should move borrowing rates for the bank's clients from the sevens into the low sixes.
Super. Well, I'm sure that'll be a popular item there. I know you economists don't like to talk about politics, but I mean, obviously, politics has played a big role in this whole interest rate thing, and it continues to play a bigger role. I mean, I think there's been more attacks to the Fed in different fronts. I mean, do you see that at that point? Have we seen all the effects of the politics in this process? Do you think?
I hope so. I mean, I think the chairman, Jay Powell's term will be up in May of next year. Trump will get control, through his when he's able to replace people as they roll off. I think you have to sort of leave the Fed alone. The Fed has to have independence in order to really do its job well. It's not a political institution. They're civil servants, not politicians.
Right.
And so hopefully we've moved past that with this administration.
Let's talk a little bit about the markets. It's been up and down, but I think net has been pretty strong for the year, and certainly third quarter. Where do you see some of the winners and losers in the market, and how do you see the S&P behaving to all the things that we just talked about?
Well, I think AI is clearly driving the S&P. I mean, the S&P 500 was up approximately 8% the third quarter, about 15% year to date. I think you probably have another 5% possibly this year. I think the big question mark is what inning are you in AI? Are you in the third inning or the sixth or seventh from a CapEx spending? And then is it going to be like the dot-com cycle where there's overspending and a lot of these models don't pan out over time when there's a rationalization period? So I think those are all issues. I think you've got a valuation problem within the S&P 500 where the market historically is 24 to 25 times earnings. And that's very historically expensive. It's a historical range of 17 to 19.
So a correction maybe?
Well, it's possible. I'm not going to say when it's going to occur, but what's happened is you sort of bifurcated the market. Everything that's AI related is trading at extremely high multiples. And then all the consumer and all the rest of the market is at very low multiples. And somewhere in the middle, the truth will happen. But I think there's the possibility that other areas of the market can do better maybe as we move forward into 26, like healthcare and industries like that have really, they've sort of perked up but haven't really performed that way. Because AI will have impact across all sectors over time.
That's right.
It just and how does that affect? What are the implications to growth rates within those industries?
Super. Well, listen, thank you so much for your input. You're a valuable member of our executive team here, and we rely on a lot of this documentation to make decisions on budgeting and everything else. And we're hopeful and certainly can feel certain that this is very helpful to our clients. And so thank you for your time and your effort. For those that are interested again in a printed copy, please go to pnfp.com econ. This is part of our effective advice series, so you'll find resources on our website there as well. So thank you very much, Mac, and thank all of you who had joined us today.
Thank you.